Hello, everyone. This is JT Rick, EVP of Finance and Investor Relations. Welcome to the pre-recorded discussion of Flowers Foods 2024 second quarter results. We will host a live Q&A session this morning at 8:30 a.m. Eastern. Further details about the live call, along with our earnings release, a transcript of these recorded remarks, and a related slide presentation are posted on the investor section of flowersfoods.com. Before we get started, keep in mind that the information presented here may include forward-looking statements about the company's performance. Although we believe these statements to be reasonable, they are subject to risks and uncertainties that could cause actual results to differ materially. In addition to what you hear in these remarks, important factors relating to Flowers Foods business are fully detailed in our SEC filings. Providing remarks today are Ryals McMullen, Chairman and CEO, and Steve Kinsey, our CFO. Ryals, I'll turn it over to you.
Thanks, JT. It's a pleasure to welcome everyone to our call. Our strong second quarter results reflect the successful execution of our strategic plan. Guided by our portfolio strategy, we're driving growth and taking market share in our higher margin branded bread products, while simultaneously improving the profitability of our private label and away from home businesses. This building momentum bolsters our confidence that we will deliver results in line with our 2024 guidance. Second quarter financial performance was highlighted by growth in our retail businesses and strong sequential margin improvement aided by the successful execution of savings initiatives. Sales came in slightly better than we expected, helped by improving volume trends in the fresh packaged bread category, which turned positive towards the end of the quarter. We believe this improvement was influenced by consumers shifting more spending to at-home eating as they look to economize. And we are capitalizing on that shift, driving unit growth of 1.5% in the fresh packaged bread category. That growth spurred share gains as our branded bread products continue to outperform the overall category, gaining 40 and 20 basis points respectively of dollar and unit market share, the most of any competitor. For the second consecutive quarter, we grew both dollars and units in tracked channels, while the bread category was largely flat. Momentum built through the quarter, with unit share gains peaking in the final 4 weeks, up 40 basis points. Particular areas of strength include sandwich buns and rolls, breakfast, and loaf, where we gained 80, 30, and 20 basis points of unit share respectively. Importantly, our performance improved in both the mass and grocery channels. Bread is a mature and stable category, but we're outperforming by focusing on subcategories that offer noteworthy growth potential for us, such as specialty premium, sandwich buns and rolls, and breakfast. And the mix shift within our branded retail bread sales is benefiting margins. From a geographic perspective, performance was particularly strong in underpenetrated regions such as the Northeast, Mid-Atlantic, and Upper Midwest, where new business wins and strong market execution drove continued growth. We're also making substantial progress in our away from home and private label businesses. As we continue to margin up existing accounts and replace business exits with newer, higher margin accounts, profitability has improved meaningfully, and we've narrowed the margin gap relative to branded retail. Our confirmed new business wins and pipeline of potential additional wins give us confidence for continued improvement in the second half of the year and beyond. Further, the headwinds from deliberate exits are waning. The impact of those exits peaked in the first quarter and will diminish significantly in the second half of the year, with virtually no effect in the fourth quarter. Now I'll provide an overview of our second quarter performance in the context of our 4 strategic priorities: developing our team, focusing on our brands, prioritizing margins, and pursuing smart M&A. Following that, Steve will review our financial results and guidance, and then I'll close with a discussion of key themes moving forward. The strength of our second quarter performance is the direct result of the hard work of our team. I'm particularly proud of their ability to grow our market share in a dynamic and challenging environment and successfully execute on our strategy to reduce cost and drive margin expansion. As we adapt our team to the evolving competitive landscape with an eye toward becoming a best-in-class selling organization, we made exciting changes to our retail customer sales team. The new structure employs a channel-focused approach that allows us to better align with and service our largest customers. Leading our restructured retail customer team is Meredith Wiktorowski, who has joined Flowers as Senior Vice President and Chief Customer Officer. She is responsible for retail customer strategy and accountable for growing our revenue, market share, profitability, and reputation. With more than 26 years of sales experience, Meredith most recently served as Vice President of Retail Sales for PepsiCo Beverages North America, North Division. I'm excited about the benefits we expect from Meredith and her team and believe these changes will help position us to drive sustainable, profitable growth. Our second strategic priority is focusing on our brands, which were a critical component of our strong second quarter performance. Our leading brands posted exceptional results, with Wonder, DKB, and Canyon growing units 10%, 7%, and 5% respectively, and Nature's Own maintaining its unit sales. That performance drove the largest dollar and unit share gain of all companies in the category, with each of our national bread brands gaining or maintaining dollar share. Dave's Killer Bread and Wonder each gained 20 basis points of dollar share, while Nature's Own gained 10 basis points. Nature's Own success is particularly noteworthy given the impact of inflationary pressures on consumers. The brand's focus on the consumer's desire for both differentiation and value drove improved results despite that environment. Consumers are flocking to our keto products, with dollar share in the subcategory up 710 basis points. We expect the introduction of keto buns to maintain that momentum. Recognizing the consumer desire for increased value, we introduced Nature's Own Small Loaves, which are off to a great start. These new products have helped the brand grow units versus the year-ago period in 6 of the last 7 weeks. And with the benefit of recent capacity additions, Canyon Bakehouse is reigniting its growth, increasing dollar share in the gluten-free category by 260 basis points. Innovation is a key part of our growth strategy, and our new products are driving strong results. The original DKB snack bars continue to receive solid support from consumers. Taking brands into new categories is rarely easy, but DKB's track record of successfully entering adjacencies like breakfast and sandwich buns and rolls gives us confidence that it can further extend into snacking. Early results at top accounts, where velocities are in excess of the category average, highlight the potential upside as we replicate best practices at other retailers. The nationwide launch of DKB Amped Up Protein Bars is underway, and we're executing a soft launch of DKB Snack Bites with a goal of more than 2,000 points of distribution by the end of 2024. We expect to expand distribution nationwide in 2025, and I remain excited about the potential of these new and innovative products. Our third strategic priority is margins, an area where we made significant progress. We spoke last quarter about the need to further improve our cost structure to better leverage our solid top-line results and deliver increased profitability. As part of that process, we redoubled our efforts and increased our expectations for savings initiatives for the year from $30 to $40 million to $40 to $50 million. Specific actions included select workforce reductions, reduced third-party spend, enhanced effectiveness of marketing investments, improvements in lease labor and indirect procurement spend, and efficiencies in our DSD network, among others. That work resulted in a significant sequential improvement in SD&A cost as a percentage of sales. In addition to savings initiatives, we're improving our branded retail mix by successfully executing our portfolio strategy, growing premium brands like DKB and Canyon, and adding innovative products like keto in core brands like Nature's Own. We've also improved the profitability of our away-from-home and private label businesses through a deliberate process of ensuring each account meets our margin targets, which I touched on earlier. Our second quarter performance highlights our growing culture of ownership and accountability. We're successfully instituting a mindset of continuous productivity improvement related to cost across the organization. Our fourth priority is smart M&A. In addition to strengthening our position in core categories by expanding our geographic reach and gaining share in underdeveloped markets, we're also focused on finding new revenue streams across the baked foods category. We seek compelling brands that complement our existing portfolio and that skew towards a better-for-you nutritional profile. Our strong balance sheet positions us well to act when we have financial, commercial, and operational conviction. Now I'll turn it over to Steve to review the details of the quarter, and then I'll close with our outlook for the current business environment. Steve?
Thank you, Riles, and good morning, everyone. Let me echo Riles on congratulating the team on an outstanding quarter. We are pleased to present our solid second quarter results. Total sales decreased 0.2% from the prior year period. Price mix improved 1%, driven primarily by mix, and was more than offset by volume declines of 1.2%. Those declines were largely due to targeted sales rationalizations and QSR market weakness. Branded retail volumes were flat, with continued growth in bread products offset by declines in cake. Gross margin as a percentage of sales, excluding depreciation and amortization, increased 90 basis points to 49.9% over the same quarter last year. Comparisons benefited from moderating ingredient and packaging cost, improved sales, price mix, and decreased product returns. The impact of lower production volumes, higher workforce-related and bakery maintenance costs, and increased outside purchases of product partially offset the overall improvement. Selling, distribution, and administrative expenses as a percentage of sales were 38.5%, a 30 basis point decrease over the prior year period. Lower distributor distribution fees, marketing expense, and consulting cost, and an insurance liability claim in the prior period were partially offset by increased workforce-related cost, amortization of cloud-based applications, higher rent expense, and lower scrap-related income. Excluding matters affecting comparability, adjusted SD&A expenses were 38.2% of sales, flat with the prior period. GAAP diluted EPS for the quarter was 32 cents per share, a 2-cent increase over the prior year period. Excluding the items affecting comparability detailed in the release, adjusted diluted EPS in the quarter increased 3 cents over the prior year period to 36 cents. Turning now to our balance sheet, liquidity, and cash flow. Year-to-date, through the second quarter of fiscal 2024, cash flow from operating activities increased by $40 million to $168 million. Capital expenditures decreased $7 million to $61 million and included $3 million for the ongoing ERP upgrade. Dividends paid increased $4 million to $102 million. We believe our financial position remains strong. At quarter end, net debt to trailing 12-month adjusted EBITDA stood at approximately 2 times. We held approximately $7 million in cash and cash equivalents and had approximately $517 million of remaining availability on our credit facilities. Now turning to our outlook for 2024. As Ryals said, we are maintaining our previously issued guidance, which calls for sales to be flat to up 1.6%, adjusted EBITDA of $524 to $553 million, and adjusted EPS in the range of $1.20 to $1.30. We are updating our expectations for depreciation and amortization, interest expense, and share count, which are detailed in our earnings release and slide presentation. We are pleased with the results of our cost-saving initiatives and expect those benefits, in addition to new business wins, to build as we move into the fourth quarter. As Ryals noted, the effect of business exits remains a headwind in the third quarter and will be fully lapped by the end of the quarter. Based on those factors, we are comfortable with the middle of our guidance range. Key factors that could shift results within our guidance range include the potential impact of an uncertain economy on the consumer and promotional environment, and the transition of our California distribution. As previously disclosed, in fiscal year 2023, we reached an agreement to settle distributor-related class action litigation in California. We are making progress repurchasing the distribution rights, which is expected to be completed in 2025 in accordance with the settlement agreement. Approximately 95% of our key raw materials are covered in 2024. Based on that coverage, our guidance incorporates a moderation in ingredient cost in 2024 relative to the prior year. To minimize volatility and provide adequate visibility into cost, we have maintained our historical hedging strategy in which we attempt to increase the certainty of our key ingredient cost 6 to 12 months out. Our ERP rollout went live in the second quarter of 2023, and we are proceeding deliberately in that implementation to ensure we continue to effectively meet market demand with our traditional high service levels. As noted previously, we have paused the bakery rollout to concentrate resources on our California distribution transition. In fiscal 2024, we expect cost for the upgrade of our ERP system to be approximately $25 to $35 million, including $3 to $6 million expected to be capitalized. Costs related to the project year-to-date are $12.8 million, of which $3.4 million has been capitalized. Total costs for the life of the project are $226 million, of which $115 million has been capitalized. Thank you, and now I'll turn it back to Ryals.
Thank you, Steve. Now I'd like to discuss some of the trends impacting our current performance and the steps we're taking to maximize present and future opportunities. I'll first touch on the consumer trends and then address the competitive environment. Consumer trends in the second quarter remain consistent with the recent past. To maximize the value of their spending, consumers have shifted more of their purchases to food at home and specifically to value channels like mass and club stores, areas where we have a strong presence. And within the store, bread, which appeals to those seeking value, is outperforming the overall food category with unit sales down only 0.2% compared to food category units which declined 0.7%, as shown on slide 9. We continue to see encouraging trends in the bread category. Premium products are performing well as consumers seek differentiation, best exemplified by DKB's strong results. Subcategories with more differentiated offerings such as dinner bread and rolls, sandwich buns and rolls, and especially premium, outperform the less differentiated traditional loaf. At the lower end of the market, slide 10 highlights that private label lost unit share in the quarter as price gaps with branded products compressed. Private label prices continue to increase at faster rates in the category, and consumers responded well to incremental promotion of branded products. And as private label unit performance has deteriorated, slide 14 highlights that we grew branded retail bread volume in tracked channels for the second consecutive quarter, up 1.5%. Those results significantly outpaced the category, which declined 0.2%, as shown on slide 9. Consistent with our portfolio strategy, the result of that growth is that our branded retail category increased to 64.5% of sales in the quarter, up 40 basis points from the year earlier period. Turning now to the competitive environment, which remains rational with promotions below pre-pandemic levels. As economic pressure drives many consumers to seek greater value, their response to promotions has increased, though off of a low base due to the pandemic impact. And in that environment, we have increased our promotional levels somewhat, resulting in a higher percentage of products sold on promotion. However, we're leveraging our trade promotion management capabilities to do so more efficiently and with attractive returns on investment. In addition to seeking greater value, consumers are also looking for differentiated products, and that desire is manifesting itself in the strong performance of our leading brands. Consumers are clearly recognizing our brand's differentiation, driving the largest dollar and unit share gain of any company in the category. We're investing to increase that differentiation, further aligning our brand portfolio with the consumer. In closing, I am pleased with the improvement demonstrated by our second quarter results, even as we acknowledge the potential impact that an uncertain economy could have on consumer behavior and the promotional environment. We continue to execute our portfolio strategy, investing in our brands and improving our mix. To better leverage our top-line performance, we improved our cost structure, significantly enhancing our margins. And we're leveraging technology to improve data visibility and drive better strategic decisions while investing in our team to advance overall execution. Results in the quarter demonstrated progress towards our long-term goals, and we'll continue working to drive further improvements. I look forward to continuing our progress throughout 2024. Thank you very much for your time. That concludes our prepared remarks.
Good morning, and thank you for standing by. Welcome to the Flowers Foods Second Quarter 2024 Results Conference Call. Please be advised that today's event is being recorded. I would now like to hand the conference over to your opening speaker today, J.T. Rieck, Executive Vice President of Finance and Investor Relations. Please go ahead.
Thank you, Shannon, and good morning. I hope everyone had the opportunity to review our earnings release, listen to our prepared remarks, and view the slide presentation that were all posted earlier on our Investor Relations website. After today's Q&A session, we will also post an audio replay of this call. Please note that in this Q&A session, we may make forward-looking statements about the company's performance. Although we believe these statements to be reasonable, they are subject to risks and uncertainties and could cause actual results to differ materially. In addition to what you hear in these remarks, important factors relating to Flowers Foods business are fully detailed in our SEC filings. We also provide non-GAAP financial measures for which disclosure and reconciliations are provided in the earnings release at the end of the slide presentation on our website. Joining me today are Ryals McMullian, Chairman and CEO, and Steve Kinsey, our CFO. Ryals, I'll turn it over to you.
Okay, thanks, JT. Good morning, everybody. I'm very pleased with our solid top and bottom line results in the quarter. Our leading brands are outperforming the category, growing volumes, and gaining market share. And our portfolio strategy is enhancing profitability in our private label and away-from-home businesses. At the same time, our savings initiatives have improved our cost structure, significantly boosting our margins compared to the first quarter and enabling us to better leverage our top-line performance as we go forward. The inflationary environment is encouraging some consumers to seek value, but many are increasingly looking for differentiated products. And that desire is manifesting itself in the strong performance of our leading brands. Consumers are clearly recognizing our brand's differentiation, resulting in the largest dollar and unit share gain of any company in the category. We're investing to increase that differentiation, further aligning our brand portfolio with the consumer. Our quarterly performance bolsters our confidence that we'll deliver results in line with our annual guidance. We're working to drive further improvements, and I look forward to continuing our progress throughout 2024. So with that, Shannon, we're ready to open it up for questions.
Thank you. To ask a question, please press star 11 on your telephone and wait for your name to be announced. To withdraw your question, please press star 11 again. Please stand by while we compile the Q&A roster. Our first question comes from the line of Robert Dickerson with Jefferies. Your line is now open.
Great. Thanks so much. Happy Friday. Good morning.
Hey, Rob.
Hey. Raul, I guess just a question around the promotional environment. The prepared remarks you said you have promoted a little bit more. It doesn't sound like a lot, but a little bit more. And at the same time, clearly it looks like you're taking both unit and dollar share in bread. So I'm just curious, I feel like since the beginning of the year, the guidance has allowed for some promotional risk, right? And maybe some increase in that promotional activity as you get through the back half of the year. You've promoted a little bit more. You're also taking share. So I'm just curious, as we sit here today, you feel like there's maybe a little bit more risk because usually, if you're taking share, then maybe others notice and they could start to promote more. Thank you.
Yeah, sure, Rob. Thanks for the question. Yeah, look, I suppose that's possible. And we indicated, in our prepared remarks and even embedded in the guidance that we're accounting for that risk as we go through the year. We called it out at the beginning of the year, and I think it's still prudent to call it out now. As we noted, consumers are responding a bit more to promotions, whereas not too long ago they were not. And we all know that the consumer is, alongside of differentiation, the consumer is seeking value. I think we saw that in a large retailer report this week. We're seeing the channel shift, and we've been calling that out for several quarters now, from grocery to mass, club, dollar, and that's kind of across income spectrums too. So, to sum up, I think it's only prudent that we continue to watch that and be a little bit cautious as it relates to our outlook. Having said all that, while promotions are up, things still remain pretty rational and are still well below pre-pandemic. So, you'd have a ways to go before you got to kind of 2019 promotional levels.
Okay, fair enough. And then, it sounds like, as you got through kind of the end of the quarter, you started to see some improvement in these trends, and you called out, an increasing, shift maybe back to at home to seek value. Now middle of August, what we've seen in the data kind of through July was ongoing, actually even improved a little bit. I don't know if there's any way to provide any color, kind of as what you've seen, let's say, through kind of the summer months and kind of how you're thinking about that momentum into back to school. Thanks.
Yeah. So, we have a large food service business, and a significant component of that is quick serve, fast food chains. And, it's been in the news. Folks have seen results at some of these QSR-oriented restaurants be a little bit challenged. And I think, a lot of that is inflation, obviously, but it also affects, our food service volumes, since that's a pretty significant part of the portfolio. But on the flip side, that tends to, benefit the retail business. And so I do think that that's somewhat of a tailwind for our branded retail business as we, move through at least the next couple of quarters. We'll kind of see how the economy does.
Okay, super. I'll pass it on.
Thanks, Rob.
Thank you. Our next question comes from the line of Bill Chappell with Truist Securities. Your line is now open.
Hey, good morning. This is Davis Holcomb on for Bill Chappell.
Morning.
Just wondering if you could maybe help us kind of unpack the impact of the business exits on volume. If there's any way that we can kind of get a quantification where volume's kind of flattish up, what does it look like directionally, I guess, from there?
Yeah, sure. We don't break that out to that granular of a level, but when you look at volumes in the quarter, they were very positive overall on the branded retail side, and particularly on the branded bread side. Now, that was somewhat weighed down by weakness in the cake business. You've seen that across the sweet baked goods category. And then as for the rest of the business, as we said, food service volumes have been a bit weak due to that QSR weakness, in addition to the strategic exits that we've talked about for several quarters now. However, it's important to remember that those strategic exits roll off in Q4. So they have virtually no impact on us in Q4. We're almost through them, as we mentioned last quarter. And so going forward, you'll see much less impact from that.
Excellent. Thanks. And I was just also wondering if you could kind of help us get a feel for how the distribution, I guess, is going for the DKB, like the protein bar rollout and everything like that. Just a little bit more color there.
Yeah, sure. Overall, we're really pleased with how well we're doing. Look, it's, as I've said several times before, this is a startup business for us. It's brand new. It's a different form of merchandising. It's not distributed DSD on the bread trucks. It goes to the warehouse. Right now we have a limited number of SKUs, so we're working to expand our shelf presence. We've got the 3 snack bars. We've got the 3 protein bars that are coming out. So our shelf presence is getting better. At our top accounts, large retailers where we're doing well, we're doing really well. And we've got velocities, well within the top 10 in the category. However, there's been a couple of places where we've stubbed our toe from an execution standpoint, and that's part of the learning curve, and we're correcting that. But looking at it overall, we think we've got a great product under a great brand umbrella, and we're very confident about where this is going. Not to mention the additional pipeline of innovation with the snack bites coming later this year and then full distribution next year. So overall, we're pleased.
Awesome. Thanks for the color. We'll go ahead and pass it on.
Yeah, thank you.
Thank you. Our next question comes from the line of Jim Salera with Stephens. Your line is now open.
Hey, good morning, guys. Thanks for taking our question. Roz, I wanted to maybe see if we could run through puts and takes on, if we look at the exits from the business impacts, you mentioned the pressure on the QSR business, but then if we think about netting those against the strong results at DKB and Canyon, plus what seems like a benefit from food at home shift.
Hey,
we
Jim,
take all that and yep.
Jim, sorry to interrupt you. Can you start your question over, because we had some really bad audio at the beginning of your question?
Yeah, no problem. Is that better?
Yes, it seems like it is.
Okay, perfect. I was just asking if we could maybe net the exit from the business impacts with some of the pressure you mentioned in QSR, and then thinking about that against the strong results of DKB, Canyon, benefit from a shift at food at home. If we think about all that together, could we see positive volumes in 3Q and then obviously, rolling into 4Q?
Yeah, I think definitely for 4Q, that's a reasonable assumption, particularly with all the new business, Jim, that we have coming on. We talked about that last quarter, so that'll have more of an impact in Q4. And then with the roll-off of the strategic exits, if we can continue to enjoy good momentum from all the brands you mentioned, then yeah, I think that's a distinct possibility. I mean, frankly, we were almost there in Q1. Branded retail was actually pretty positive in Q1. So, yes, I think that's a reasonable possibility.
Okay, great. And then maybe if you could just give us some detail on, you mentioned in your prepared remarks, restructuring the retail team. Can you just talk about how that changes some of the capabilities relative to the previous structure, and maybe when/how we might see that show up on shelf?
Yeah, I mean, I think you got to give us a little bit of time. And Meredith just started not just a few weeks ago, but we brought Terry Thomas on as the Chief Growth Officer. He had some significant experience and insights from his time at Unilever and other places. And one of the things we lacked here was a channel-specific approach to strategy and execution at the retail level. And I think that's one of the areas where it's got these restructurings are going to benefit us the most. Whereas before, to shorthand it, it was a little bit of a peanut butter spread approach to all channels. Now you're looking specifically at mass, you're looking specifically at club, dollar, whatever it might be. And even as we roll out our snack items, convenience is a tremendous opportunity for us because we're so deeply underpenetrated in that channel.
Great. Appreciate the color, guys. I'll hop back in the queue.
Thank you, Jim.
Thank you. As a reminder, to ask a question at this time, please press star 11 on your touchtone telephone. Our next question comes from the line of Mitchell Pinheiro with Sturdivant & Company. Your line is now open.
Yeah, hey, good morning. Curious, you talk about making headway in some of your underpenetrated geographic regions, and I'm curious, what's driving that, and is it sustainable growth that you can see there? Because it's a big part of your growth story. Is while you have extraordinary strength in the South and Southwest, there's a lot of sort of white space, and just curious if it's sustainable.
Well, we certainly think so. As you rightly pointed out, our largest share concentration is in the South. That's a pretty saturated market for us. There's still certain growth pockets, and we're seeing that with the Nature's Own Keto Loaf. Dave's continues to grow. And then, even in the South, if you break up the geographies and look at, market share gains, it's been a little bit tougher in the South, frankly. A little bit more promotional activity, basically two primary competitors, our most mature market. But what we've been able to do is find areas within the category to grow. So that's keto, that's breakfast, that's sandwich buns and rolls, even in the South. Now, more directly to your question on underpenetrated markets, I absolutely think that's sustainable. When you look at a 17-18 overall dollar share nationwide and only a 10 in the Northeast, and we haven't even really been there that long. Dave's been there, DKB's been there for even less time. But as you know, a lot of we don't have a national marketing campaign, at least not yet. So that's one of our focus markets for our advertising campaign. We've still got room to grow out west, Pac Northwest, and probably most importantly in the upper Midwest, which we've already started to enter, and we'll continue to roll that out as we go forward. So, not only do we have M&A to look to, innovation to look to, but we've also got these underpenetrated regions where we've got a lot of runway to grow to get our fair share of the category.
Okay, thanks for that. Then on margins, Steve, in the prepared remarks, you talk about moderating ingredient and packaging costs. Is that something, obviously you have a lot of visibility there with the amount, with you're pretty much set for the remainder of this year with visibility there. Is that something we're going to see, not just moderating increases, but are we going to see declines?
Yeah, I mean, obviously, when you look at kind of the margin performance year to date, we've done really well, and we're pleased with where we are. We continue to hedge. I mean, our strategy hasn't changed. We say 6 to 9 months, ahead of the market, so we understand, the cost structure. We did see the first half is actually the largest benefit with regard to the moderating cost. So while we do expect benefit in the back half, that benefit will begin to decline somewhat. But, overall, we're still, forecasting, decent margin improvement for the year.
And then I guess this one last question, just on M&A. You've been a little quiet. Do you anticipate? I'm curious what the pipeline might look like, and whether whether or not are you sort of waiting for a lot of the ERP and California and things like that to sort of get behind you before we see M&A, or are they two just unrelated and mutually exclusive?
No, we're ready to go. I mean, when the right opportunity comes along, it's time for some M&A for us. And I'll reiterate again, we're very proactive in the market. We're out there building relationships. We know what could be coming. We know what we're interested in. In some cases, we've even done some advanced, commercial diligence work so that we're able to execute quickly when the right opportunity comes along. And again, those opportunities can come both in the core and in adjacent categories. I do think, there's been some big deals announced over the last week and the last 6 months or so, but I think there's more ahead. The M&A market seems to be getting healthier, as we noted last quarter. So we're bullish on that, Mitch.
Okay. All right. Thank you. Appreciate the questions.
Okay, thanks.
Thank you. Our next question comes from the line of Steve Powers with Deutsche Bank. Your line is now open.
Hey, thanks, and good morning, guys.
Hello, Steve.
So first question, just a little bit more color on how you're thinking about the price versus, or so the kind of reported price mix versus the volume outlook across branded retail as we go through the back half. Obviously, you kind of cycled a year ago pricing actions. But if like most recently in the data that we all kind of track week to week, it looks like pricing in the category pricing for your own portfolio has dipped negative. So as we go through the back half, as you make those targeted promotional investments, and you probably have some channel package mix that's negative despite the premiumization trend, or is the base case that reported pricing runs negative in the back half with volume making up the difference, or do you think you can hold price mix to kind of neutral as you flow through 24?
Yeah. So let's break it up a little bit. On the branded side, all of our pricing is in. Now, when the data that we look at, Steve, our average price was up 7 cents in the quarter, not down. But that's also driven by mix, because as we've talked about, DKB had a great quarter, Canyon had a great quarter, Nature's Own did well given the environment, so that mix is driving that a bit. Mm-hmm. And if we can continue that trend, and Steve, you should comment on this too. If we can continue that trend, I would expect mix to be a positive benefit for us as we move through the rest of the year.
Yeah, right. Obviously, as Ryals said, all of our branded pricing is in. You've seen the kind of the cost environment as well, and also some slight promotions. So mix is a big part, the back half. And then as Ryals said, if brands continue to perform well and things play out as we think with some of the new business, by the fourth quarter we might see some positive volume, as well.
Okay, great. And just on ERP as it relates to the bakery rollout. Obviously, that's on hold pending the California distribution transition. I guess as we look out through that transition, how quickly? What's the base case plan for when the bakery rollout resumes? Is that sort of middle of 25 or sooner or later? How do we think about that?
Today we're obviously trying to work through California, but the plan is to pick back up bakery rollouts late this year or first quarter of next year.
Okay.
And then come up with a pretty strong plan to try to stay on our original targets. Obviously, if things shift, we'll let you know. But I think the good thing is right now, from an overall cost perspective, we're not anticipating anything to change. So that's critical from that standpoint as well.
Okay. So the resumption could happen before the distribution right purchases are fully complete. That's what I'm gleaning from what your answer was.
Yes, the goal is to pick back up no later than Q1 of next year.
Okay, perfect. All right, thank you very much.
Thanks, Steve.
Thank you. And I'm currently showing no further questions at this time. I would now like to turn the call back over to Riles McMullen for closing remarks.
Okay, thanks, Shannon. Thanks, everybody, for taking time today and joining us for questions. We appreciate your interest in our company. And as always, we look forward to speaking with you again next quarter. Take care.
This concludes today's conference call. Thank you for your participation. You may now disconnect.